So you've just saved up $1,000. How can you invest? How can you start investing? Where should you invest? So I get that question asked a lot. What can I do with $1,000? Where can I put it? Well, before answering this question, first of all, you have to know what type of personality you have. Do you want the type of investment where you'll be more active, or do you want the type of investment where you'll have a more passive approach? Also, what is your goal with that $1,000? Do you want to generate income from that $1,000, or do you want to create wealth? So if you're looking for a passive investment, two things come to mind: either the stock market or real estate. Now, can you start investing in real estate with only $1,000? Probably not. But if your plan is to go with real estate, you can definitely save up, put that $1,000 on the side, and save up until it becomes, let's say, $10,000, enough for a down payment. Now, why would you want to go into real estate? By far, real estate is definitely the easiest way to become wealthy and retire early, because it allows you to generate income every month, but also create equity, create wealth, and it has a compounding effect. Let me explain. So let's say you save up $10,000, which is enough for a down payment, a 5% down payment on a $200,000 condo. So that leaves you with a mortgage of $190,000. Now I'm keeping things simple, not including all other costs, just keeping it simple, just to get the general idea. That $190,000 mortgage is probably going to have a payment of about $900 every month. Plus, if we add property taxes and condo fees and insurance, let's round that up to $1,200 a month. Now, depending on the area you live in, rent will be different. But let's say you're able to rent this place for $1,300. So your total cost per month for this property that costs you $200,000, you simply put $10,000 down payment to get access to this property, but you borrowed $190,000 mortgage from the bank, and you're paying $1,200 a month to pay down that mortgage, but you're renting it out for $1,300. So every month you're making an income of $100. $1,300 minus $1,200. So that $100 extra is your income. 100 times 12 months in a year is $1,200. $1,200 divided by your $10,000 down payment, which is your investment, basically, represents 12% of your investment. So your $10,000 investment allowed you to generate 12% income per year. So as you're getting $1,300 from your tenant, you're taking $1,200 to pay down your mortgage. You're keeping $100 as income. Now the $1,200 that's going towards your mortgage, you're actually paying down. Part of it pays interest, of course, but the other part pays capital. You're paying back the loan on your property. So when you first started off with your apartment, it cost you $200,000. $10,000 of that is yours. It's your down payment. The rest, $190,000, is borrowed money. It's not yours. But as the months go by, you're paying back that debt. So you're creating equity in your property. So on a $900 mortgage payment, you're probably creating about $500 in equity every month. So the beauty of real estate is that the tenant is paying down your mortgage, allowing you to generate wealth, to create wealth with leverage, because you only put down $10,000, but it gave you access to a $200,000 property. So 5 years go by, you're able to rent your place for every month in that 5-year period. You're probably going to end up with a mortgage balance of about $160,000. So you started off with a property of $200,000, a mortgage of $190,000. 5 years later, you have a mortgage of $160,000. Your property is probably worth $220,000, $230,000, if not more. So look at the equity that you just generated. 230 minus 160. So in this example, you just generated $70,000 of equity by only investing $10,000. Plus, you were getting $100 a month in income. Now, here's where the compounding effect happens. What do you do with that equity that's been created? What you could do is withdraw part of that equity and use it as a down payment for a second property. So now your first property has a new mortgage of, let's say, $210,000. Your second property, to keep things simple, we're going to use the same numbers. You bought a second property for $200,000 with a 5% down payment. So you start off with a mortgage of $190,000. So your total monthly expenses is $1,200 for that second property, and you're renting it out for, let's say, $1,350 because rent has increased, for example. And your first property, you're also renting it out for more because rent has increased, but your mortgage is relatively the same because you withdrew the equity out of the first mortgage. And then another 5 years go by. As you're collecting rent, your mortgage balance goes down, generating equity again, but this time in both properties. So notice how you only started with $10,000 at the beginning, and then 10 years later, you have two properties that have probably in each at least $70,000 of equity, and you're able to generate between $100 and $150 a month in income, depending on where you live. And then you could do it again with a third property. You can withdraw equity from your first or second property, use it as a down payment for your third property. And then as you collect rent and pay your mortgage down, you create equity once again in all three properties. So as you can see, there's a compounding effect. You're creating wealth and equity faster and more properties that generate income for you. So you can retire early and live off the rental income. So if real estate is the route that you want to take, you might not be able to start with $1,000, but you can definitely put that $1,000 in a high interest savings account and save up until you reach enough for a down payment on a property. Instead of giving up and saying, oh, $1,000 is not enough for real estate, so let me just use that $1,000 towards something else. But then you never have enough for your first down payment because you're always taking your next $1,000 saving and putting it somewhere else. Then you might miss out on that real estate opportunity. So it's important to choose the route that you want to take based on your personality, whether it's more active or passive. Now, real estate starts off being more active because you have to get a mortgage. You have to find a bank that will get you a mortgage. You have to find the right property in a great location, a property that can be easily rented, and a property, obviously, depending on your level of involvement, a property that doesn't require much maintenance or renovation. So there's going to be a bit of research to do before buying a property. And then you have to find the right tenant, the tenant that will not cause you headaches, the tenant that will not damage your property, and a tenant that will pay on time. So that's why I say that at the beginning, real estate can be more of an active investment. But then once you have enough properties, you can actually hire a property manager to take care of all that and simply give them 10% of your rental income. So even real estate can become very passive, but it definitely requires a bit more involvement from your end because you have to look for tenants. You have to deal with more people. So if you don't like dealing with people, maybe real estate is not for you because it's definitely a people business, whether it's tenants, whether it's looking for contractors to fix things in your properties, whether it's dealing with property managers. So that's why I say you have to know what type of personality you have to choose the right investment. But definitely real estate is a great way to become wealthy and retire early. It's not in buying a property 100% in cash. It's about leverage. It's about using that bank loan. It's about having that tenant pay down your mortgage. That's the true benefit of real estate. So you don't need to have 50% down payment to get into real estate. 5% is enough. You don't have to feel bad for having a big loan. As long as you're able to find a tenant quickly, that tenant will pay down your loan. Now, the other option for investing based on your personality, if you don't want to deal with people, if you want something more passive, something that you can manage wherever you are in the world, then investing on the stock market is a great choice. And the most passive way of investing on the stock market is through dividend investing. So some companies pay a portion of their earnings to their investors. So if you buy a stock, let's say CIBC, a Canadian bank stock, if you buy CIBC, you put $1,000 in CIBC stock, you will get about 4 to 5% in dividends per year. So you'll get about $50 per year. Now CIBC pays their dividends every 3 months. So you'll get about 50 divided by 4, whatever that is, every 3 months. That's if you're investing $1,000. Now, the beauty of dividend investing is that it becomes very passive. If you never sell your stock, if your plan is to just keep buying dividend stocks, so stocks that pay dividends, you can, if you're not going to use these dividends, if you're not going to spend these dividends, you can reinvest these dividends to buy more stocks that pay dividends. So there's another compounding effect. And companies increase their dividends year after year. Not only that, but the stock might increase in value. Like in real estate, your property might go up. With companies, the stock value might go up as well. So you might buy CIBC, for example, let's say at $100. In 1 year, it could reach $110 or $120. So your $1,000 invested becomes $1,200. Not only that, but you've been collecting dividends for the past year. Let's say $50. Now, of course, if you never sell your stock, you don't really benefit from that extra appreciation, but it's still considered equity or wealth that you're creating for yourself. But this is definitely the easiest way to invest because all it requires is an internet connection. You don't have to get approved for anything. You don't have to deal with anyone. Simply transfer money from your bank account to your trading account and then simply buy the stocks that you like. Now, there's a bit of research that you can do to pick the right stocks at the right time, but it's definitely less complicated than investing in real estate and finding the right properties, getting approved for a mortgage, finding the right tenants. What's so great about dividend investing is that it's so easy to set up. You simply pick your stock, you buy it, and if you never sell it, you just watch the dividends come in. So every time you have $1,000, you transfer it to your trading account, you buy the stock that you want, and you're slowly growing your dividend stock portfolio, a portfolio that has stocks that pay dividends. And easily in 20-25 years, depending on how much you're contributing every month, you can easily find yourself with $1 million, generating you maybe $60,000 a year. Now, depending on your risk tolerance, real estate might be better for you, because with real estate, price of properties don't fluctuate as much as companies on the stock market. For example, you can buy CIBC at 100, but then if we go through a recession or a stock market crash, CIBC could be trading at $50. So you just lost half of your investment. You'll still be getting your dividends though, but your investment is worth 50% less. But with real estate, property value always goes up, assuming you're buying in a great location. You'll never see your property drop 50%. So there's less stress in that sense, but you do have the stress of vacancy. What if your tenant leaves? Will you be able to find a tenant quickly in order to meet your mortgage payments? Now, there's many ways to invest on the stock market, but the easiest and most passive and safest way is dividend investing, to buy quality companies that are never going to go bankrupt, that pay at least 4% dividends, buy them, never sell them, and just keep collecting dividends. While you're building your portfolio, you can reinvest the dividends to buy more stocks that pay dividends. And then once you're ready to live off the dividends, then you can start withdrawing the dividends to live off. Doesn't get any easier than that. The only downside to dividend investing is that it does take a bit of time to build and requires a good amount of capital. But you have to start somewhere. So if you have $1,000 and your goal is to maybe retire in 25 years and you want to grow your money, you want to invest it, you want to create wealth but also generate income, dividend investing on the stock market is great. If you don't mind to be a bit more active, if you like dealing with people, then real estate is even better, because you can create wealth even faster, because there's the power of leverage. You're borrowing money from the bank to control that much property. Now, going back to the stock market, you could also swing trade. So instead of buying stocks just to collect dividends and keeping the stocks forever, you can actually buy stocks low and then sell them a little bit higher. And when you sell, you're making a profit. That profit that you're making, you can either see it as an income or as a way to grow your money. So you started off with $1,000. Let's say you buy CIBC stock at $100. It might go down a bit, but then after 3 months, the stock is trading at $110. You could sell it at $110. You make a 10% return. So your $1,000 is now worth $1,100. So now you take your $1,100, you look for another opportunity, and you repeat. And then maybe by then you would have saved another $1,000 that you're going to invest in the stock market. So now you've got more money or more choices. Now the problem with swing trading is you might not always be able to buy the stock at the lowest price. You might think you're buying it at a discount, but the stock could continue to drop or could trade horizontally for a while. So then your $1,000 either loses value or remains $1,000 for a while without doing anything for you. Now, let's say you've got $5,000 and you decide to invest only $1,000 in each stock, and your strategy is to swing trade, to buy low, sell a little bit higher. Now, what are the chances that all 5 of your stock choices go down after you buy them? Probably not so high, but it could happen. Now, obviously, to increase your chances of being successful, you want to stick with stocks that are always innovating, that will never disappear, and that have a proven track record of constant growth. So you've got stocks like Visa and MasterCard. If you look at their charts, they're always going up over time. If a stock like Visa or MasterCard drops all of a sudden, you feel confident in buying it because you know that eventually it will go back up or above your purchase price. Something like Amazon, for example. When Amazon was trading almost at $1,400 back in December 2008, that was a great opportunity to buy, because you know that it's almost guaranteed that it's gonna go back up to $2,000. And if you look at the chart, it didn't take that long for Amazon trade around 1800 or even 1900. So you would have made a decent return on your investment if you had bought Amazon at 1400. But Amazon didn't drop from 1800 to 1400 in one day. It dropped gradually from 1800 to 1700 to 1600 to 1500. So you might have thought that when it dropped to 1700, oh, that's a good price. So then you buy it. You might have thought that 1600 was a good price, but then it just kept going lower afterwards. So swing trading can become a little bit less consistent because you're not always going to time the market. But that is another way of trading on the stock market or investing on the stock market. It does require a bit more involvement. So it's not as passive as dividend investing, but it's definitely something to consider as long as you stick to quality stocks, companies that you love and trust. So if you've finally saved up $1,000, this would be the best way to invest. These are some of your options depending on your personality type and what your risk tolerance and what you really want from that $1,000. If you want real estate, then put that money in a high interest savings account like a Tangerine account that pays over 2% until you've accumulated enough to use as a down payment on a property, at least $10,000. Obviously depends where you live. Some places in Canada you can buy an apartment for $60,000, and in other places you need at least $200,000. Or you could invest on the stock market, which is very easy to do. Simply open a broker account with any of the banks or even an online discount brokerage like Questrade. You could use my referral code in the description below to get up to $250 back when you open an account with Questrade. You can even use Wealthsimple Trade, which has 0 commissions if you buy Canadian stocks. But if you do plan on buying US stocks, you'll have to pay for conversion fees. So I hope this video helped you decide how to invest your $1,000. If you have any questions, leave them in the comment section below. Thanks for watching.